Hello, everybody. So today I want to talk about consumer stocks. You have mostly consumer stocks in this spreadsheet, and I also have more specifically direct to consumer stocks, which is another type of company doing very well right now in the 21st century. These are all disruptive companies that are trying to disrupt legacy ways of doing business, legacy products, and they are well suited within my investment style. And briefly, my investment style, if you're new to the channel, it is this. It's getting in at the beginning of the product adoption S curve, buying a stock at the beginning of the S curve, and typically product adoption before a product comes from really anonymous, nobody's heard about it, to mainstream takes about 10 to 15 years. So my holding period, well, ideally it'd be more than 15 years, but if it's 10 to 15 years, I'll be okay. Pay the capital gains then, just ride the adoption curve, and as soon as there's signs of a slowdown, and assuming there's no new S curve beginning on another product, then that's when I'd be interested in selling, when there's types of a slowdown. But I ride S curves, and I try to ride product adoption S curves. That is my style of investing. And I also have a little value in my style of investing. I love growth, but I don't like to pay for it very much. I like to have a good price on my growth, which is why I use enterprise value over gross profit over revenue growth, which is answering the question, how much am I paying for each 1 percentage point of revenue growth? And of course, you want this number to be very low. You'll see on some stocks out here, this number is very low, namely Oddity and HIMS, somewhat of similar business models, but HIMS is more in health, Oddity is more in beauty, but somewhat similar business models, and they are very, very cheap EV over gross profit over revenue growth. The reason why I use gross profit here and not say EBITDA or anything like that is because what do we consider? Say things like marketing, things like R&D. Do we consider marketing to be an expense, or do we consider marketing to be an investment? Do I consider R&D to be an expense or an investment, right? If you're a traditional industrial company from the 60s and you apply the accounting standards that have been, taught at business schools for 70 years, you're going to be like, well, you shouldn't use gross profit because, actually marketing is an expense, right? Marketing is awful. So you should be using EBITDA margin. You should be using operating profits. That's what should be using, because marketing is an expense. But what we find is that for most companies, that's actually not true. Marketing is not an expense because products are more and more recurring. And so if you have a product that's going to stick to the customer, if you have a product that's gonna like be purchased for, say, a decade or 2 decades, then I look at marketing as a reinvestment in my business. It's a reinvestment in the business. And of course, marketing is not depreciated or amortized, but nonetheless, it is an investment. This is why most people still don't understand Amazon and still look at Amazon as overvalued. That's because Amazon looks at these pseudo expenses that were seen as pseudo expenses back in the day. It looks at it as investments, as real options as to what the future is going to be. So that's why I like gross margin much better than, say, a net margin. But I nonetheless added a form of net margin, which is EBITDA margin. The reason why I use EBITDA is because I think it's a better proxy for cash flow, and it's more stable over long periods of times when you use EBITDA. So you can do a better comparison and don't have single quarter items that kind of mess up your analysis when you use adjusted EBITDA. And I'm including the rule of 40. So the rule of 40 is really the adjusted EBITDA, so the economic profitability of the business, plus the revenue growth. And when you add both of those, it's going to add up to 40 or more. And obviously for the rule of 40, the higher, the better. And that's something that we get from SaaS and from the world of VCs, venture capitalists. They always want to invest in companies that have this rule of 40. And most of these stocks that I present today, aside from Lovesac, but we'll see, it might be a little idiosyncratic for Lovesac to not be there. Aside from Lovesac, all of these stocks that I present today have a rule of 40 or more. I mean, especially in the case of HIMS, we're at a rule of 76. That's actually a mistake for HIMS. HIMS is not there on EBITDA margin. HIMS is a little lower. So just keep that in mind. But I'm not going to analyze HIMS today because I've covered HIMS a lot on this channel. So let me get started. Talk about Oddity. So Oddity is a company that reported earnings yesterday. They did very well. Stock was up yesterday 16%, but actually it just recouped some of the losses that it had gathered over the past 2 months. So Oddity is still, in my view, a very cheap company. I own the stock. I like the stock. I think it's a very interesting play. It's like a HIMS for the cosmetics world. It's a play on the customization of cosmetics. Oddity is known for their main product. The main product is called Makiage. That is a foundation. And if you know anything about this type of foundation, makeup for women, you know, everybody has a different skin color. And it's very subtle. And there's thousands of possible different subtleties in anyone's skin color. And so that's where AI comes and plays a role. So what Makiage does is it scans your face. It uses AI to scan your face, and it creates a custom foundation for you that is exactly the color of your skin. And that really is a disruption right there, because most cosmetics companies, typically when they sell foundation, they have like, say, 20 or 30 shades, and that's it. But really, what we find out is there's thousands of different shades. And so this is why the product is very sticky, because once a woman has found the right color, she has a tendency to not switch, right? She has a tendency to stick. And so that's why there's a huge recurring revenue component for a company like Oddity. And they're doing this with skincare, and they're looking at doing this in 2 other brands upcoming, 2 other, which we don't know, which haven't been announced yet, in the sector of beauty, beauty / a little bit of healthcare when you get into dermatology, but in the sector of beauty and customizing that one-to-one cosmetics, one customer, one cosmetic, one unique customer, one unique type of makeup. So it's kind of like what HIMS is trying to do, but HIMS is doing that, of course, for health. Oddity is doing it in the cosmetics space. And so this has a lot of advantages, such as, of course, people in cosmetics don't expect health insurance to reimburse you. So it's an easy sell, if it makes sense. It's regulated. Cosmetics are regulated. They're way less regulated. As long as you ship a safe product, it's way less regulated than, say, RX, right? Prescription drugs. So that's another advantage of kind of doing a HIMS for the cosmetics space. And whether it is, so in this spreadsheet here, let me just talk about briefly the direct-to-consumer conversation. So whether it is Oddity, whether it is On running shoes, whether it is Lovesac or HIMS, all of these are also direct-to-consumer plays, i.e. DTCs. So what is the DTC play? Well, that's a classic innovator's dilemma problem. So let's take the case of Oddity, right? So they sell foundation, they sell cosmetics. There's a lot of competition in cosmetics, but like take L'Oreal, right? It's not like L'Oreal can say, oh, I'm gonna launch a great website on Instagram, on TikTok, and it's going to be L'Oreal.com, and I'm going to promote it on TikTok, and I'm going to undercut my distributor. I'm going to undercut the Walmarts, the Macy's, the Targets, all of those stores. I'm going to go ahead and undercut my distributor, with whom I've been working for 70 years, 50 years. I'm going to undercut them, and I'm going to sell my product online, exclusively online now. They can't do that. And that's the classic innovator's dilemma. They can't do that, because if they do that, these big companies, these behemoths, they kill their cash flows if they do that. Right? That is the same story right now of Ford trying to get rid of the dealership. Right? Ford realizes that dealerships are not their allies, and they're working really hard to try to get rid of a dealership and sell direct to consumer. But you can't do that, or it's very hard to do that. At least the companies that are good are those that are actually able to do that. And we know that the direct-to-consumer model is the better, more profitable, and especially more suited to the 21st century model. And that's why all of these 4 brands that I've just outlined that use DTC, they are fighting against competitors that have inertia, which prevents them from applying that same strategy. These competitors can't apply that same strategy. They have a very hard time killing the cash cow. And that's why I think we see a lot of direct-to-consumer stocks on the rise, and they're going to be much more on the rise going forward. So going back to the numbers here when it comes to Oddity, revenue growth predicted to be at 33%, again, unheard of in the cosmetic space. That's very high for such an industry that is, stagnant, right? It's kind of a stagnant industry. I remember back 20 years ago, one of the big deals of this industry was to try to get men to wear makeup, because if you do that, then you double the market size. But they haven't been very successful about that. There's actually a lot of interesting things like that. Harley Davidson was doing the same way. Harley Davidson was trying to get women to ride bikes in droves, just as many as men, and so that also didn't work out. So the market is kind of what it is. The market is what it is, and the market is not growing very fast. And you have a company here that's growing super fast in a very well-established market. And that has a lot to do with a direct-to-consumer model, in my view, for promotion on TikTok, on Instagram. And the EBITDA margin is there at 21%. They achieve a rule of 40, of 54. The gross margin is outstanding at 72%. And Oddity is a company that has about 60% recurring revenue. So it's outstanding. I love this stock. I own it. I'm very happy. Let me move on to a second stock. This is my second time discussing Dutch Brothers on the channel. So Dutch Brothers is a coffee chain in the US. It emerged in the West, and I must say that I have tried it yesterday, and this video was kind of triggered by me trying Dutch Brothers yesterday. They are growing fast in Texas, and so there's one that just opened up across the corner from me, and I just tried it yesterday. And two observations for Dutch Brothers. First of all, huge lines in the morning. Drive-through line kind of blocks the highway, so that's always a very, very good sign. I don't know if it's a novelty or not. I know this is a brand that is very popular among Gen Z, but I actually tried their coffee. I tried one of their lattes, like a regular drink you would get at Starbucks, right? I found it significantly better than Starbucks. Now I know, food and beverage, that's so personal that it's tough. You can't make a statement like that. It's all personal. I found it very tasty. I was very impressed and compelled by the products sold at Dutch Brothers. And I myself, I'm kind of an espresso snob, and so I like to think that I can detect decent coffee. I thought that it was better than Starbucks. I'm not saying it's the best coffee, but it was better than Starbucks. Like in my view, quite a bit better than Starbucks. And the question is, are customers noticing this consciously or subconsciously? Like Starbucks, like if you're a coffee snob, dark roast coffee is not very good. And you go to Starbucks, most of the time dark roast is all that is brewed. I'm sorry, I'm going on a tangent here, but dark roast is all that is brewed. If you're into coffee, dark roast, you're just burning the beans. Anyways, and Starbucks doesn't make the best coffee in my humble opinion, unless you go to a fancy Starbucks that actually knows coffee, but it's really not the case. It's a matter of opinion here. The point is, the coffee was pretty good in my view, and the same price as Starbucks, and the stores are so much more efficient than Starbucks. Dutch Brothers doesn't have a dining room, right? You order it outside at the window. They just have a few lawn chairs type thing. The footprint is very tiny. These stores are much smaller than Starbucks, and I peeked through the window of Dutch Brothers, and I gotta tell you, the automation, the cleanliness, the automation, the way the machines are set up, seems highly efficient to me. Much more efficient than, say, what you see in a Starbucks, where it's kind of this open line where they try to sell you a bunch of stuff, and at Starbucks they kind of do so many different things. Kind of gives you the vibe that Starbucks may be turning into a Subway. I don't know. I don't go out much at all, so I'm definitely not the best reference. coffee was good, and that's nice. That's important. Looking at the numbers, so let's look at the numbers. The gross margin is terrible, 27%. I don't like that. I wish it was higher. Now you're operating in the physical space with actual physical humans making a physical job, and a physical work. So of course you're not gonna grow as fast as a purely digital company, but the stock is cheap, trading at 3.6 times revenue. That's cheap. The revenue growth is there at 26%. And how much am I paying for that growth? It's actually not too cheap. They're actually paying up for that growth. And so the question is, how quickly can they grow? On Dutch Brothers, you might also have kind of a real asset play, because they are having a wholly owned growth strategy, kind of like Starbucks, right? They're not doing franchise. They're owning these assets. So I like the company. I think the stock to me is a tad expensive for my taste, but I like the company, and also they achieve the rule of 40, which is nice. So they have EBITDA margin at 14%. And if you add that to the revenue growth, that's a 40%. So I like the company. I like it much better than a Starbucks, but I don't own it, and I don't plan to own it unless we get a drop in the stock price. I find it a little expensive, but the coffee was pretty good. And this depends on your investing style. Like if this is a business you want to be in, I think it's a very compelling play. Like if you want to be in the coffee business and invest in the coffee business, I think that's a very compelling play, Dutch Brothers. The question is, do you want to be in this business? Well, it's a good business because caffeine has an addictive component, and it makes people come back, right? So you have kind of this built-in recurring revenue in caffeine that you say you maybe don't have, in other business. So just putting that out there. Okay, moving on to Celsius. Now, I own Celsius. Celsius is a decent position for me. It's not a 5% position, but it's not a 1% position either. It's about 2.5 to 3%. Celsius is a decent position. It's a stock that I had sold, I bought back in, and now I'm holding it for the long run because the evidence suggests that Celsius is winning. Celsius is winning the energy beverage war. There's no two ways about it. They run out of the stuff. In grocery stores, in convenience stores. I still see as many young people grab it as I used to, right? It's a beverage that is equally popular among men and women, contrary to their competitors like Red Bull or Monster, which is more popular among men, right? It's a beverage, Celsius, that is enjoyed at all times of the day, including in the morning, which is very different from, say, coffee. Coffee tends to have, coffee is beginning of the day until, I don't know, 3 p.m., something like that. So coffee is not sold all day. Celsius is clearly being sold all day. Red Bull sold in the morning? Not really, right? So they've really marketed themselves there. And they've also marketed themselves as a healthy drink and a healthy beverage. And so the jury's still out as to whether that's the case or not. That's what they've marketed themselves as, and that's really resonating with the customer. And of course, a Celsius beverage, some of their cans, I think the heat ones are something like 200 milligrams of caffeine. Yeah, when you have a product with 200 milligrams of caffeine, people are going to be coming back, right? That's the old trick. People are going to be coming back, buying the beverage. And so that's why you get stellar numbers. Revenue growth, 54% predicted over the next 12 months. Gross margin, 50%. That's excellent. The partnership with Pepsi is really helping them out. They keep the growth. They keep growing. They're going into Europe. They just entered Canada recently. And how much am I paying for that growth? Well, it's cheaper than a Dutch Brothers, but it's still somewhat expensive, but really cheap because it's under a 0.5, and under a 0.5 on EV over GP over RG is a good price, and they are profitable at 22%. So you get a rule of 76, which is the highest here in the spreadsheets, because HIMS is off. HIMS is lower than that, right? EBITDA margin on HIMS is 9%. So HIMS actually the rule of 40 is in the 50. So it's really excellent. And once again, Dutch Brothers, Celsius, I talked about Starbucks too. like whether one likes the beverage or not, I mean, it's really a matter of personal preference. And if there is one area of the world where there's so many different personal tastes, it's food and beverage, right? Food and beverage is so culturally dependent that some people are gonna love it, some people are gonna hate it, and it's not as universal, as say an iPhone or a smartphone, right? Like everybody has a smartphone, right? Foods, not everybody likes all types of foods. That's because it's one of these things that is so culturally dependent. And so I like Celsius. I like Dutch Brothers. I think they're both interesting. I know in the comment section many have told me that you hate the taste of Celsius, and so that obviously if you hate the taste of Celsius, you may not want to invest in that. Looking at another company that is very visible, which is On Running Shoes. Again, so On. Since I covered this company, I own the stock, by the way. It's a starter position, but I own on running. But, I learned about this company online, right? In the comment section of this channel, actually, and y'all told me about it. And, they have a very specific design. So when you research it, they have a very specific design, these On shoes. And what I've noticed is that once you've seen the design, you can't unsee it. You know it's On shoes when you see it. And of course, I've been noticing them everywhere now, and I see them on people's feet everywhere. Like people are wearing those a lot. And whenever I go to somewhere trendy, I don't go much to these places, but whenever I go on a walk, walk downtown, anything like that, I see a lot of people wearing those, and this design is very recognizable, and so. This tells me these shoes are very, very popular. They have really nailed something, and are they high performance shoes? Well, it's debatable. I don't know much. I know they're well ranked. They're ranked out there with Oka, right, as high as Oka, but. Running shoes, On Running Shoes or Okas, that story is always the same story. In that case, it's the disruption of legacy players. It's the disruption of Nike, the disruption of Adidas, the disruption of these brands who have their distributors who can't really get the distributors out of the picture, and they are not as free to sell their products as, say, an On Running is. And because of that, they have great metrics. If you look at On, that's great metrics. The revenue growth is 34%. The gross margin is 60%. That's quite high. EV over revenue is cheap at a 4.74. And you're getting almost to the top 20% cheapest at an EV over GP over RG of 0.23. And they are profitable at 12%. So you get a 46% rule of 40. It's a compelling stock, which is why I own it. I'm very happy about that. Now, Love. I don't own Love anymore. I had bought a tiny position and I sold it, but I want to get back in Love because Love is my is kind of my real estate bounce back type play. So this used to be, you can see the stock is still very compelling on a valuation basis, even growing at 7% revenue growth. It's still compelling at a 0.16. Now, when this stock was growing just a tad faster, just a little bit faster, it came to be as cheap as HIMS to be. This is pretty crazy, right? So love is what? Love is the disruption of legacy furniture brands. Namely, I can think of one brand that I think it's disrupting, and it is Lazy Boy in America. So Lazy Boy in America, brand from the 20th century. They make recliners, they make couches. They have these giant stores that must cost a fortune, and their couches also cost quite a bit of money, like $7,000 or $8,000 for a couch. And that's the brand Lazy Boy, and they're from Michigan. Anyways, in my view, they're totally getting disrupted, in my view, by the new young comer, which is Lovesac. Lovesac got started with bean bags, and so if you watch my analysis of this stock, I show you recliners and I show you bean bags, and really how do we consume entertainment, the economy of laziness. Well, it turns out a lot of younger people prefer to have beanbags, and they prefer to have poofs, and they prefer to just have these reconfigurable furniture, and I think Love is really winning in that space, and in the way that they sell. It's a very powerful way that they sell. They have very, very tiny showrooms you order online. The showrooms are tiny, and I remember in one of their investor presentation, they were showing how their furniture store was 6 times more productive, like in terms of revenue per square foot, 6 times more productive than your average furniture store. So it's quite impressive in my view. Now, of course, furniture companies, like most companies in that space, crashed because real estate is dead forever. Nobody's ever going to buy a house forever, ever, right? I mean, no, it's wrong. Obviously, it's wrong. Obviously, real estate's not dead forever. I believe we're coming out of this rut that real estate's been in. There's a lot of households that have been holding off from buying real estate, that have been holding off from household formation, all that sort of stuff, because they can't afford it. But as soon as they can afford it, of course, furniture will come back into play. And furniture is very linked to real estate. One buys a house or a bigger space, and then you get furniture to go in that space. And that's why I think love can shine as soon as the interest rates drop, which is why I put my CME Fed Watch tool here. And as you can see, all it does when you push forward, and we were supposed to get a rate cut in May, we didn't. In June, we didn't. In July, it looks like we're not going to get anything in July. But all you're doing is postponing by a few months the rate cuts. The rate cuts are still coming, albeit a few months later. But so now it's what? Now what are we saying for a rate cut? We're saying September rate cut, right before the election, right? And we're saying then November rate cut. So we're saying still 3 rate cuts until the end of the year. But all that means, because we've delayed those rate cuts, all that means is that you're going to get more rate cuts in 2025. That's all it means, because there's no way out. Beat the denominator, right? The name of the channel is based on that, the fact that there is no way out. Zero interest rates is the only way that the government can handle the debt. The government can handle the spending that it does. The government can handle the unemployment payouts that are gonna come, the social security hole, the debt forgiveness all over the place. The student loan debt forgiveness is at more than $200 billion, with all of these different executive orders that the president has been to cancel. That $200 billion, that's a lot of money. The money that we send to foreign countries, to foreign wars, right? They just approved and over something like $70 or $80 billion. That money is not money that we have. Right? That money is money that is borrowed by the U.S. government, and interest rates cannot be this high for the U.S. government. Otherwise the debt would go through the roof. They can't be this high, and so they have to be dropped, and they will be dropped. I have full confidence. I mean, no advice, no investment advice, no financial advice, but I have full confidence that the interest rates will be dropped the same way as Japan. Japan is the future of most fiat economies, in my view. So anyways, because of that, when interest rates drop, real estate's going to boom again, right? And we're going to see an era in the U.S. where the average house is $1 million. That's going to happen. Is it going to be late 2030s, mid 2030s, early 2040s? I don't know, but that's going to happen. That's going to happen because we're going to drop these rates. And so, of course, when rates drop, people feel rich and they go on and they buy furniture. So that's why Lovesac is a stock that I would be interested in getting back before the rate cut. Okay, let me go briefly over HIMS. I've covered HIMS so much on the channel. I know some of you are kind of like nauseated with me covering HIMS all the time. So I'm just not going to cover it too much. But it's still my favorite direct-to-consumer stock. I think it's a very compelling DTC type stock for me. Very cheap. I mean, it beats just about every other stock here on the metrics, except for Rule of 40. Remember, it's in the 50s. The EBITDA margin is 9% for him, not 34. I made a mistake, but didn't quite want to re-record the video, so that's why. But remember, it's in the 50s here. So the other numbers are correct, right? It's 42% predicted revenue growth for the next 12 months. Gross margin is 82%. So the price, how much am I paying for that growth, is really 0.07, which is dirt cheap for a business whose growth is unabated, for a business who is early, in my view, is early to into the early majority of their S curve. There is a runway for him, so a 10-year runway. In my view, maybe more, but there is a runway, and that's a stock I want to own for a long run. I'm very happy owning it. I understand some people don't like HIMS because of the CEO tweets or because of I guess reductive analysis, calling it just an ED company. It's not. If you study it closely, you'll see that it's not just an ED company. This narrative has been dead for 3 years. But anyways, that's what people still say. And I'll finish with Inmode. So Inmode, I'm only putting Inmode in there because someone, every video I've posted, I can't remember who it is, but one of you in the comments has been asking for Inmode every single time in the comment section. So I'm putting Inmode in there. So Inmode, what do? They are in between like intensive cosmetic surgery where you have to be put to sleep, and they do like the cosmetic surgery, like the heavy duty stuff, right? And the laser procedures. So the laser procedure is very light, and you do like laser contouring. I don't know all they do. I mean this is a business that mostly sells to women. So I don't know all that they do, but I know they are right in between their procedures. They charge to the customers for the procedures between $7,000 and $10,000. That's the cost of a procedure. And say, for example, like a very popular procedure for them is their body tights procedure. So body tight is, for example, is you can do a laser procedure and you can do some laser contouring, and you're gonna lose some weight in the belly, right? Or it's gonna look like your belly has like fat in a better way shaped in the belly. Or you could do a full liposuction. So a full liposuction is a surgery, is expensive, it's $30,000, and you have an actual doctor putting you to sleep, sucking the fat out with surgical machines. So that's not what it is. Or you could do something like their Body Tight product, which is micro needling, and they melt the fat with dozens of teeny tiny needles that they insert in your belly, and they melt your fat. And so it's more expensive and more intensive than laser, but it's less intensive, less scary, less costly than a full surgery, right? I mean, who wants to be put under total anesthesia just for a belly job? I guess that's what they would be called, or something like that. Like, who wants? That makes sense. Like, who? I mean, I get it that some people want to do that, and there's but it's risky. So I think Inmode is compelling in the sense that you don't have to go for like a risky full surgery, right? You can just do a kind of in between. And you may ask, so why is the revenue growth only 5%? Well, I'll point out the revenue growth used to be much faster. The problem is that these machines are $70,000 to $100,000. And the doctors, right, the medical offices who do those procedures, they don't have $70,000 in cash to pay for that. They usually borrow on loans that are very close to personal loans in terms of interest, which means that the interest rates right now on these loans is something like 16-15%. And so they're just not buying new machines at 16% interest rates. And so Inmode has been working to try to get those interest rate downs, do some interest rate reduction partnerships, find some financing partners, etc. But this is a business that as soon as the interest rates drop back to close to zero, those doctors, the personal loans interest rates will also go down, and those doctors will be able to buy more machines from Inmode. So Inmode, in my view, is in a wait-and-see type of approach. They're wait-and-see. And meanwhile, while they're wait-and-see, you may have noticed that the EBITDA margin is stunning at 39%. 39% margin. So and the gross margin is equally stunning, right? The highest in the spreadsheet, 83%, but it's 39%. So why do they make so much money if they don't sell that much new stuff? Why do they make so much money? Well, that's because Inmode is a consumable story too. Each, let's say, like you do the body tight procedure. I think the body tight procedure is something like, depending on how much fat you want them to melt, but let's say it's like a five session procedure, right? Each of these sessions you have to buy a micro needling tip, and that tip, from what I see, is between $100 and $200 depending on the tip, right? And of course, it's single use. So there is that business that whenever someone goes for that treatment, you have a single use micro needling tip that needs to be set up on the machine that costs $100 that has 80+% gross margin. So it's a consumable business. It's kind of like the Nespresso of fat loss, if that makes some sense. But it's a company that is clearly within the trends. I don't understand why it's so cheap, trading at 1.6 times revenue. Why is it so cheap? I don't understand. It's a company that's well suited within the trend of consumers, and you can really see what a lot of consumers care about, right? A lot of consumers care about health, and Celsius claims to be good for health, right? A lot of consumers care about looks, and so they get Oddity for their looks, or they get HIMS for their weight loss, and then Inmode, if you listen to the last conference call of Inmode, that was one of the very interesting things about it, is they actually think GLP-1 agonists, those weight loss drugs, those blockbuster weight loss drugs that are really miraculous drugs, if you ask me, they make you lose weight, but then you have issues where your skin is not tight, and so your belly is kind of flabby or something. You don't have tight skin anymore, and they have a skin tightening procedure, and they have a bunch of procedures which, once you've lost the weight, you can also tighten your skin with all of these different procedures. And if you look up their website, their machines, they have all sorts of machines, and they do the skin, like especially for the face, like the chin, like for your face. Like if you lose weight fast, you might still have a face. Anyways, it's a business. It's an ecosystem. And by the way, maybe when it comes to Inmode, when it comes to Oddity, when it comes to Celsius, maybe we need to thank Instagram, and perhaps to a lesser extent TikTok and influencers. Maybe they are a major driver of this cultural shift right now. They might very well be that. So maybe Facebook in there might be an interesting play, or whoever ends up buying TikTok. So anyways, a little bit of a tangent today in this video, but this is a video just as much for me as it is for you. I hope you enjoyed this video. This is no financial advice, no investment advice. This is just entertainment. Please like, please subscribe. Thank you so much for watching, and have a wonderful day.